You've probably heard a lot about Bitcoin, future of currency, maybe, a hedge against inflation. Some even call it a safe haven.
Mm-hmm.
But what if the story is, well, a bit more fragile than all that hype suggests?
Yeah, that's what we're digging into today.
Welcome to the deep dive. Today we're cutting through some of that noise. We've got a really interesting source we're going to unpack, looking at the core arguments around Bitcoin and the technology behind it, the blockchain.
And that source is a paper called Bitcoin, Currencies, and Fragility. The author comes at it from a quantitative finance angle, which gives it a, let's say, pretty critical perspective on some of those popular beliefs.
Exactly. So if you're listening and you want to get past the headlines, maybe you really understand the arguments about whether Bitcoin can actually work as money or as a reliable way to store value, well, you're definitely in the right place.
We're going to try and pull out the key insights for you without getting totally lost in the weeds.
Our mission, really, is to get to grips with what this paper argues about Bitcoin's potential, but also its significant limitations, trying to separate the tech promise from the, well, sometimes pretty tough financial realities.
Sounds good. Where should we start?
Okay, let's dive in. Starting with the foundation, right? The blockchain. Now, the paper gets a bit technical early on, talks about things like chained nonlinear transformations. For those of us who aren't math whizzes, what's the basic idea there?
Okay, think of it like stacking Lego blocks. But each block's shape is determined by the one directly underneath it in a really complex, unique way. These transformations are like mathematically scrambling the data in a new block based on the data in the previous one.
Okay.
The cool part is, if you know how the first block looked, you can check every single block added afterwards to make sure it fits perfectly. But trying to sneak back and change an older block...
It would mess up all the blocks on top.
Exactly. It makes the whole history, the whole ledger, tamper-evident. It creates this verifiable, chronological record.
Like a digital ledger, where you can't secretly rip out a page or change an entry without everyone noticing. And the paper mentions this hash function. What does that add to the mix?
The hash function is like a super secure fingerprint generator for digital data.
Yeah.
You feed it any information, a single transaction or a whole block of them, and it spits out a unique fixed length code, the hash.
A fingerprint, okay.
And the crucial property, what's called collision resistance, means it's basically impossible for two different sets of data to create the same fingerprint. So if someone tries to alter even one tiny detail in a past block,
the fingerprint changes.
Instantly. And because each block's hash includes the hash of the previous block, changing one block changes its hash, which changes the next block's hash, and so on, all the way up the chain. It's a clear signal something's wrong.
Got it. So that built-in security, without needing a central bank or company to validate everything, that's what underpinned the whole idea of a peer-to-peer public ledger in the original Bitcoin white paper.
Precisely. The goal was direct exchange of value, person to person, no middleman. And the paper points out something interesting. Bitcoin didn't invent all this tech out of thin air.
Right.
It cleverly combined three existing ideas. The hash function, something called a Merkle tree, which is just an efficient way to structure the transaction data within a block, and this concept of proof of work, all had roots in earlier computer science research.
Okay, proof of work. We hear that term a lot, usually alongside miners.
Yeah.
What's their role in this system?
So the miners are essentially the bookkeepers, or maybe the security guards, of this distributed ledger. They gather up new pending transactions, verify them, bundle them into a new block, and then they compete to solve a really difficult mathematical puzzle. The solving process is the proof of work. It takes a ton of computational effort, and that means using a lot of electricity.
And why do they bother?
The incentive. The first miner to solve the puzzle gets to add their validated block to the chain. And as a reward, they receive newly minted Bitcoins, plus any transaction fees people included with their payments in that block.
And this puzzle, it gets harder or easier depending on how many miners are competing?
Exactly right. The system automatically adjusts the difficulty of the puzzle. The goal is to keep the rate of new blocks being added roughly constant, about one every 10 minutes. So if more miners jump in and start solving puzzles faster...
the puzzles get harder.
Yep. Requiring even more processing power and thus more energy. This escalating energy consumption is a major point the paper highlights as, a potential drawback, especially ecologically speaking.
And the whole system kind of depends on these miners staying motivated financially to keep doing this forever, basically.
That's a core argument about its fragility in the paper. Bitcoin's persistence relies on this continuous economic incentive for miners. If mining stops being profitable, the network security and operation could be compromised.
Interesting. And the paper also mentions that the system is built on inherent distrust.
Mm.
But also that ownership can get very concentrated.
Yeah, it's a bit paradoxical.
Hmm.
Decentralized control, but relies on no single entity being trusted. Yet data shows Bitcoin ownership follows a power law distribution, similar to wealth in many countries, meaning a small percentage of addresses hold a very large portion of the total Bitcoin.
And one other key point. Transactions are irreversible. No take-backsies.
Absolutely. Once it's confirmed on the blockchain, it's final. Which has pros and cons. Good for finality, bad if you send coins to the wrong address or get defrauded.
Definitely. Okay, now the paper brings up this idea that because the total number of Bitcoins is capped, was it 21 million?
Yeah.
It's fundamentally a zero-sum game. What does that mean practically?
Right, the numerous clauses, that fixed supply. Unlike, say, shares in a company that can grow its business and pay dividends, Bitcoin itself doesn't generate any yield. It doesn't produce anything.
So any profit comes
Comes from someone else being willing to pay a higher price than you did. The total value within the system doesn't inherently grow. It just gets redistributed based on buying and selling. It's a closed loop in that sense.
Okay, that makes sense. So we've got the tech basics. Now, the paper makes a pretty bold claim, arguing that Bitcoin's fundamental value might actually be zero. How do they get there?
This is where they introduce a concept from finance called cumulative ruin. It's a bit theoretical, but the core idea is this. If you have an asset that pays no dividend or interest,
Like Bitcoin.
like Bitcoin, and if there's any chance, even a tiny one, that its value could someday fall to zero and stay there, hit an absorbing barrier is the technical term, then rational financial theory suggests its present value should also be zero.
Whoa, okay. Why?
Because that future possibility of worthlessness gets factored into today's price. If everyone knows it could become worthless, no one should rationally pay anything for it now, assuming they expect it to eventually hit zero. It's based on expectation.
That feels counterintuitive given the prices we see. How does this apply specifically to Bitcoin, especially compared to something like gold?
Well, the paper draws a sharp contrast. Gold is a physical element. It doesn't need active maintenance to continue existing. It's survived millennia.
Right.
Bitcoin, however, needs constant upkeep. It needs the miners, the network, the software updates, the electricity, and crucially, sustained human interest. If any of those things fail permanently, or if a better technology comes along and people just lose interest,
Poof, it could go to zero.
that's the argument. Its value is path-dependent on continuous maintenance and relevance. Gold just is. Bitcoin needs to be kept alive. History shows technologies get replaced all the time. For Bitcoin to maintain value indefinitely, the paper argues, it needs perfect immortality, which is a very high bar.
It reminds me of the dot-com bubble comparison the paper makes, but with a twist.
Yeah, that was interesting. Even the most speculative dot-com stocks back then, the ones that eventually crashed and burned, were at least claiming they would eventually generate revenue, sell products, offer services.
They had a theoretical path to profit, even if flawed.
Exactly.
Hmm.
The paper argues Bitcoin hasn't even established itself convincingly as a widespread medium of exchange or a stable unit of account for pricing goods and services, which leads directly to its next point.
That it's essentially failed as a currency, despite the massive price run-ups.
Precisely. The author calls it success in the wrong places. The speculative price appreciation has masked its shortcomings as an actual functional currency for, day-to-day life. There's confusion between an asset potentially increasing in price and a tool for stable, efficient transactions.
And what are those specific shortcomings as a payment system, according to the paper?
Well, several things. Transaction costs, first off, often much higher than using a credit card or even modern digital payment systems like mobile money in Africa. Then there's speed. Bitcoin transactions can take, 10 minutes, sometimes much longer, to get confirmed. Not practical for buying coffee or groceries.
Definitely not.
And scale. The network, as currently designed, simply cannot handle the sheer volume of transactions that something like Visa processes every second. It's not built for that kind of throughput.
Plus, very few things are actually priced in Bitcoin,
Right.
even after more than a decade.
That's a huge point. You don't see salaries quoted in Bitcoin or supermarket prices listed in it. The El Salvador example, offering residency for a Bitcoin payment, is noted as a rare exception, not the norm. For something to be a currency, people need to think in it, price in it, get paid in it.
So what does make a true currency work? The paper goes into why gold eventually stopped being the standard.
Yeah, it touches on the end of Bretton Woods. Part of the issue was that the physical supply of gold just couldn't keep pace with the growth of the global economy. It became a constraint. Commodity-backed money has inherent limitations in a dynamic world.
And that Hunt Brothers silver squeeze fiasco also showed precious metals aren't necessarily stable or reliable.
Exactly. That whole episode in the late 70s, early 80s, where they tried to corner the silver market prices, went parabolic, then crashed. It demonstrated pretty clearly that even precious metals aren't immune to speculation and aren't reliable inflation hedges or stable units of account. The paper notes neither gold nor silver are even back to their inflation-adjusted highs from that era.
So the paper defines this term numeraire as the currency most salaries are paid in. Why is that concept important?
The numeraire is like the economy's default measuring stick. It's what we use to compare the value of different goods and services. If your salary is in dollars and groceries are priced in dollars, it's easy to make decisions.
But pricing things in Bitcoin is problematic because its value jumps around so much.
Hugely problematic. Imagine a store trying to price a TV in Bitcoin. If Bitcoin's dollar value doubles overnight, is the TV suddenly half price? Or does the store constantly reprice? It creates massive uncertainty and opens the door to arbitrage people trying to profit purely from the fluctuations between the Bitcoin price and, say, the dollar price.
Like trying to pay with Bitcoin only when it's high and dollars when it's low.
Precisely. The paper uses the historical analogy of bimetallism trying to use both gold and silver as official money at a fixed ratio. It never really works stably because the market values of the metals kept shifting.
So trying to have Bitcoin operate alongside dollars within the same economy faces similar instability issues.
Yes, and even between different countries' fiat currencies, while exchange rates move, they tend to exhibit much lower volatility than Bitcoin, especially for major trading partners. The paper shows figures illustrating Bitcoin's consistently high volatility compared to major currency pairs. Plus, governments reinforce their own currency's dominance through taxation and spending.
Which makes Bitcoin a poor candidate for an inflation hedge too, despite what you sometimes hear. The paper defines that as something like a minimum variance numeraire.
Yeah, basically an ideal inflation hedge would be an asset whose price tracks the general cost of living very closely, but without wild swings of its own. It should be stable relative to the basket of goods and services.
The paper gives that funny example of the Italian telephone tokens, the Gattoni.
Right. For a time in the 70s, these tokens were so commonly used for small change that their value actually tracked the price of things like an espresso quite well locally. They acted like a temporary informal inflation hedge.
But even they became obsolete.
Exactly. Technology moved on. And that highlights another problem. The basket of goods used to calculate inflation changes over time. What constitutes cost of living evolves. So it's very hard for any single item, whether it's a token or Bitcoin, to be a permanent, perfect hedge.
The paper also mentions things like the shekel of Tyre being trusted historically, but only in a very specific context.
And it points out that even among fiat currencies, there's a kind of free market competition. Historically, businesses and individuals preferred holding or making long-term contracts in more stable currencies, like the Deutschmark or Swiss franc before the euro. Stability matters.
And for finance pros, hedging inflation is more complex than just buying one asset.
Oh, yeah. For quant practitioners, an effective inflation hedge might involve a portfolio approach, maybe shorting bonds or using other derivatives, not just holding a single volatile commodity or cryptocurrency.
Okay, so the paper makes a strong case against Bitcoin as a currency or stable hedge. Then it takes aim at some specific justifications, starting with what it calls the fallacy of libertarianism. What's the argument there?
The paper argues that some proponents incorrectly equate Bitcoin's rigid, code-based rules with libertarian ideals. But it suggests libertarianism is more fundamentally about the rule of law, legal frameworks, property rights, contracts, not necessarily just mechanistic algorithms.
So it's about governance, not just code.
Right. And often, things like Anglo-Saxon common law are preferred in commerce precisely because they offer flexibility and can adapt to unforeseen circumstances, unlike immutable code. The argument is that libertarianism doesn't automatically mean embracing total distrust or purely algorithmic systems.
Then there's the safe haven idea. First, against financial crises.
Yeah, the paper points to March 2020 again. When markets panicked over COVID, Bitcoin didn't act like a safe haven. It crashed harder than stocks. It only recovered when central banks pumped massive liquidity into the system.
So it behaved like a risky asset. sensitive to liquidity.
Exactly. Like other speculative bubbles, it seems to thrive on excess liquidity and risk appetite, not act as a hedge against systemic fear. And the paper asks, what happens if there's a major internet outage during a crisis? Its reliability is questionable.
What about the second safe haven, claim protection from tyrannical governments?
The paper is pretty dismissive of this. It argues the idea of Bitcoin offering true anonymity or protection from state actors is largely a myth. The blockchain itself is public. While linking addresses to identities takes work, it's often possible, especially for governments with significant resources.
The Colonial Pipeline ransomware case is mentioned.
Yes, where authorities were able to track and recover a significant portion of the Bitcoin ransom payment. The paper suggests governments likely have superior surveillance and computational power compared to users trying to stay hidden. Calling it an escape tyranny tool is likened to, well, false advertising.
Okay, and the last fallacy tackled is the agency problem.
Yeah.
The idea that Bitcoin removes middlemen, but the paper argues it might create a worse problem.
Right. The concern raised is about the extreme concentration of Bitcoin ownership among early adopters, the hodlers. If Bitcoin were to become widely adopted, it could result in a massive wealth transfer from newcomers to this relatively small group who got in early.
So instead of paying bank fees, you're potentially enriching a concentrated group of early holders.
That's the potential issue highlighted. The paper contrasts this with, say, the salaries paid to civil servants managing fiat currency systems, suggesting the potential for wealth transfer via Bitcoin could create a different, possibly larger, agency problem.
So after dismantling the case for Bitcoin as currency, hedge, or safe haven, the paper finally looks at the blockchain technology itself. Is that the real value?
Well, that's the common fallback argument, isn't it?
Mm.
Okay, maybe Bitcoin's flawed, but the blockchain is revolutionary.
Mm-hmm.
But the paper pushes back here, too. It argues that despite years of hype, there's actually very little evidence so far of blockchain providing significant unique value in real-world applications outside of cryptocurrencies. Many proposed uses, it suggests, can be done more simply and efficiently with existing database technologies.
And it wraps up with that joke about the Damascus cucumber.
Yes. The merchant charging a fortune for cucumbers, not because they taste good, but because they were transported by superior mules.
The point being,
The point being that a technology, however complex or clever it seems, should be judged on whether it actually solves a problem better than existing solutions, not just on its supposed sophistication or the hype surrounding it. Does it deliver a better, cheaper, faster cucumber, or is it just fancy transport?
right. So to wrap this up for you, our listener, this deep dive into the paper Bitcoin, Currencies, and Fragility really presents a deeply skeptical view.
Yeah, the core arguments are about Bitcoin's inherent fragility. Its failure, according to the author, to function as a stable currency or reliable store of value, and real questions about the practical utility of blockchain tech itself beyond crypto.
It definitely leaves us with a provocative thought, doesn't it? Given these arguments about fragility and limited practical use, should we maybe focus less on Bitcoin and blockchain as solutions and more on critically examining the problems they supposedly solve in the first place?
Exactly. It encourages you to think critically beyond the common narratives about the future of digital finance and where these technologies truly fit, if anywhere. A lot to chew on.